Good evening and welcome to the Money Show. I'm Kavita Thaplayal, and today personal finance is no longer just about savings, it's about navigating complexity. Markets are more accessible than ever but also more unpredictable. Investors are constantly being pulled between caution and greed, between protecting capital and chasing returns. And somewhere in this noise lies the real question: what actually works when it comes to building long-term wealth? In a market environment like this, one debate really stands out. Is wealth created by taking bold, high-risk bets or staying disciplined and compounding steadily over time? Because while big wins make headlines, it's consistency that quietly builds portfolios. But is that approach still relevant in today's fast-moving, momentum-driven markets? And more importantly, can investors actually stick to it? To talk more on this, joining me is Arun Kumar. Arun, hi, good evening and welcome to the show. A very important write-up that I saw online by you, and this really makes you question a lot of things, especially the very crucial concept of compounding. But before I ask you a pointed question on that, I just want to understand, are retail investors today overestimating their ability to generate high returns and underestimating risk?
Very difficult to quantify because right now the SIP flows are very strong. But I think a broad understanding is that the last few years, I mean, barring the last 2 years, if you look at the experience, it has been very high returns vis-a-vis the past. Most investors have ended up making 15-20% kind of returns. And I think broadly that expectation will need to taper down. And I think the last 2 years has kind of brought in a lot more reality check. But I think, I mean, it's going to be fine. But my sense is this SIP flow, at least being stable so far, is giving me a lot of confidence that this will continue. But yeah, the return expectation will obviously need to come down. But I think it's a part of the learning curve, and I think this time I'm very confident that all retail investors, I mean, most retail investors should be able to sail through, especially given the fact that SIP is an instrument which can, which actually benefits out of this. So
Okay.
yeah.
All right. Arun, when we talk about financial planning, we really have those traditional concepts of enhancing your return or your portfolio gains. But see, the market is never steady. I mean, volatility is a part of the market and it's its inherent nature. Now, having said that, a lot of new investors might just want to outperform the market, by navigating through various strategies. Is that the right recipe in today in a world which has new shortcomings coming ahead or new struggles coming ahead?
See, I think if you take a step back and look at, say, we have data for almost 45 years plus, right? If you look at Sensex, you historically look at it, almost every year there has been a small market fall, and generally the range is around 10% to 20%. It's there every year. There's not a single year where you have not seen a temporary fall. And some 10% falls are very rare. It's only like 4 or 5 years where the fall was less than 10. So in that sense, some bad news happening each and every year, and the markets temporarily going down 10-20% is almost given. And today's is exactly the same. So in that sense, while it looks like today is very uncertain and it's very different and all that, this is how it's always been. But despite that, if you look at any index level returns over long periods of time, will roughly been around 12 to 15%. And the other way to cut it is, if you look at the doubling time, 75% of the times in the last 25 years, irrespective of whenever you invested, you were able to double within 6 years. And remaining probably 23% times you were able to double in 6 to 8 years. So which means generally over a 6 to 10 year time frame, the experience has been very stable. It's just that every time it falls, it always feels like the beginning of a very large 30, 40, 50% fall. While those falls will happen at some point in time, it's very rare. Probably once every 7-10 year kind of a thing. And at least at the current juncture, I don't see the risk of this converting into a very large fall. But valuations are reasonable. The macros look very decent. Sentiments are becoming negative, and it's usually a contra indicator. And earning cycle is also, we are somewhere in the mid of the cycle. So broadly, my sense is this is the normal, regular volatility that you have seen for the last 45 years, and the probability of this becoming a large fall is very, very low in my view. And this is a very, very good opportunity for incremental investments and for SIP investors to continue.
But is the timeline to double your money has gone shortened?
Broadly, if you look at it in the last, barring the last 2 years, the doubling period, it was a lot shorter. Most people doubled in 3-4 year cycle. But historically, you have to assume that most of us would need, say, around 4 or 5 doubles at least, and there'll be one double which is a little lesser in time. Generally the expectation is 12%, which means that the doubling period should roughly be 6 years. But again, equities are not a very stable kind of an asset. So you'll have some periods where you do it in 4 or 5 years. You'll have some periods where you probably do it in 6.5, 7 years. But net, if you are attempting a 3 to 5 doubles kind of a scenario, overall it will more or less average around 5-6 years. Historically, at least as far as the data goes, 75% of the times you have been able to double in less than 6 years. At least the last 5 years of TRI, that's what it shows.
All right, Arun, let's move on. And the main part of the discussion is understanding compounding. Yes, there is a traditional way, but you seem to have discovered a new way of understanding compounding and, in fact, applying it in a much more simpler way. So what is that?
Yeah. So the traditional way of, everybody says that compounding is a very life-changing concept and all that, but it's very hard to intuitively get it,
right?
Because of obviously the way it is described, right? The formula goes like, if you want to calculate the amount after compounding, you put P into 1 plus R to the whole power T, which essentially P is what is the investment amount that you're going to invest, and then 1 plus R is nothing but the returns. And then to the power T is how long are you willing to wait? And generally the power comes in T. But all said, this, while the formula is absolutely right, you still need a calculator to calculate what this can do to your money over a 15-year, 20-year cycle. And hence, it's most of us don't do it and most of us don't get it intuitively. So here is it's not my discovery, but generally a different lens to view the same thing so that it gets a little more intuitive and simpler for us to understand is this idea called doubling. So instead of using this formula, you just think about how many doubles can you get. So for example, let's say you work hard and you build your first 10 lakhs. And let's think about it in terms of doubles, right? So the first double will take you to 20 lakhs. The second double will be 40 lakhs. The third double will be 80. The fourth will be 1.6 crores. The fifth will be close to 3.2 crores. Now here comes one part. So 5 doubles has taken your 10 lakhs to 3.2 crores. Another 5 doubles takes you from almost 3 crores to close to 100 crores. So this is where the whole thing blows your mind in terms of how and you can do the math and then you will figure that same 3 crores becomes 100 crores in the next 5 years. Now if you do this, what's the crux of this, right? There are 3 important points. So as I told, the first 5 doubles is very slow, which is why the compounding part is extremely slow in the beginning. So as I told, first 5 doubles is 3 crores. The second 5 doubles is 100 crores. And so compounding is always back-ended and the real increment in your amounts start exponentially going up only in the later doubles. Then the second part, if you look at it, why does this happen? Why is it that the second 5 doubles is so explosive vis-a-vis the first 5? It's because of a simple idea that every double that you do adds almost the equal or adds the equal amount of all the doubles earlier. So which means, let's say I do 5 doubles and I am at 3 crores. Now my 6th double adds the entire 3 crores again, right?
Right.
Doubles that you so the way to think about it is that the rich gets richer. It's not a conspiracy. It's just a mathematical thing because each and every double is going to give you the same amount as all the previous doubles put together. So at the 6th double, I will probably be close to 6.4 crores, and my 7th double will add the entire 6 crores again, right? So the second idea is that every double adds up the entire all doubles put together. Okay. And then the third thing is that, so which is why the sequencing matters. The first 4 or 3 to 5 doubles are a little slow in terms of impact.
Yeah.
But if you don't hang on for that 3 to 4 or 3 to 5 doubles, then you don't build a large enough base. the moment you build the large enough base, every double from there becomes very, very large and meaningful amount for your own life. So the key point is, the first part of the sequencing is you need to stay patient to build that large base. And then after that, you need to give it some more doubles so that it really becomes a life-changing amount for you. So overall, the simple idea is that whatever is your target amount, say you are at, say, 12 lakhs, and then if you want to go to, say, 1 crore, now it looks like a very, very large amount. I need 88 lakhs more. But if you start thinking in doubles, 12 lakhs, the first double will take you to 24, the second double is 50, and the third double is roughly 1 crore. So instead of looking at it as an amount, which is a lot scarier, if you start thinking that it's only 3 more doubles that I need to get to 1 crore, then it becomes a little more easier to interpret it. So I think the idea is very simple, that whatever is the amount that you're targeting, start thinking in terms of doubles, and whatever is the amount that you currently have, just see what 3 doubles can do to it, what 4 doubles can do to it, what 5 doubles can do to it. And then the next question is, how do we think about the time required for each and every double? And so you roughly know how you get to that 3 to 5 doubles, and at what point in time you can broadly get to that.
So, can this approach actually work across market cycles, especially during prolonged bull runs where aggressive strategies seem to outperform?
See, again, the way to start thinking about it is that this is not applicable to one double, because one double can be very fast or very slow depending on what point in time of the cycle you are. But broadly, most of us, from a practical point of view, we are looking at adding at least 4 or 5 doubles in our or more if possible. And anyway, because this will probably span a 15, 20, 25 year kind of a cycle, you will go through all different market cycles. So net, some doubles will be faster, some doubles will be slower, but broadly you will end up coming close to the asset class returns and what that translates into double. So let me simplify this. Now the question I told that we were missing is, how fast can I double, right? Again, there's a simple rule called 72, which basically says 72 divided by whatever is the returns that you're expecting. So let's say you are an FD investor and you expect somewhere close to 6%. Then 72 divided by 6% will roughly be 12 years. Now, if you're expecting 7% returns, then 72 by 7 would roughly be 10 years. Now, if you're an investor, FD or debt-like investor, very conservative investor expecting 6-7% returns, then it means each double for you would roughly be somewhere close to 10 to 12 years. Now, if you want 4 or 5 doubles, then you know that 100% it'll probably take you 40 to 50 years, which is a very, very long time. Now, let's say you're an equity investor and say you are expecting somewhere around 12% based on how the country's nominal growth is, and historically that's been the experience. It's a decent assumption to start with. Now you can make it more conservative, more aggressive based on your view of the returns. But let's say it's 12%. Roughly, it means that you will get a double in 6 years. Let's say you think you can do 15%, then it means it will take around 10 years. Now, broadly, 10 to 12 years. I mean, sorry, at 12% you get 6 years, and at 15% you get it in 5 years. So broadly, 5 to 6 years seems to be the sweet spot for equity doubling. Now again, putting this through, and let's say you want another 4 or 5 doubles, right? Again, roughly it will take you close to 20 to 30 years. Now the key question is, how do I reduce this probably to say 3 or 4 years?
Right.
Now, you will need close to 25% returns, which is obviously a very, very high number, and you will need to take insane risk. So the question is, if I can do 12 to 15% and I need 25% returns to make the doubling period to 3 years, how do I fix this gap? That's the question. And which is where the idea of savings as a percentage of portfolio starts coming in, because you assume that you invest once and you never invest throughout your life. But in reality, all of us, as we earn through our careers, we'll also be plugging in a lot of our savings into our investments through a 20, 30 year career. So that idea is that if you have a 10 lakh portfolio and if you can invest 1 lakh over the next 1 year, then savings as a percentage of portfolio is close to 10%. So which means there is a return component and there is the savings as a percentage which gets added. Now, broadly, the thumb rule is if you can maintain it at 15% of your portfolio, so which means for a 10 lakh portfolio, if you can do 1.5 lakhs a year, then you are crossing that 15% threshold. So then it becomes a deadly combo because you are adding 15% of your portfolio. Your returns can probably do, say, 12 to 15%. So net, you roughly end up growing your portfolio at 25 to 30%, which means you are most likely doubling every 3 years. Now, obviously, because equity returns are a little non-linear, there'll be some periods where it gets slightly delayed. But if you do it if you can think it over a 4 or 5 doubling cycle, generally you end up at, let's say, at 3 years for a doubling cycle. So then, which means 4 to 5 doubles will roughly take you around 12 to 15 years. Now, obviously, there's no linear part of it, but this is a good framework to start thinking that, hey, probably it is possible, and it is more under your control because the key component is your savings as a percentage of portfolio. So as long as that is not high, the focus should be on your career and on your spending habits. And once you build a large enough base, let's say at let's say 10 crores, and I have to do the same 15% as a percentage of my, then it is 1.5 crores per year, which is very hard. So at some point it becomes harder, but at that point in time the returns will take care. You can afford to go a little slow and probably double in 6 or 7 years because the base is large enough. So the idea is initially try to contribute as much as possible,
as much as you can, right,
at a higher thing, so that you get the first 4 or 5 doubles, and after that you can take the leg off the pedal, and you can let your portfolio and returns take care, while you can go low on your savings, because either way your savings probably might not be adding much, and I might as well go spend it. So this is a rough way to start thinking about doubling. And in terms of how fast you can double.
So, in a nutshell, try and pump in as much as you can in the initial stages. But today, Arun, we are looking at high liquidity and fast-moving markets. Have we factored in the risk of underperformance also? Because as you just explained, equity performance is very non-linear.
Right. See, again, underperformance with respect to what is the question? Broadly, the idea is over long periods of time, equity market returns across the globe has mirrored the underlying profit growth. So as long as a group, Indian entrepreneurs continue to grow their profits well, more or less you're going to end up getting close to that, the underlying profit growth. So in that sense, while it looks like a very fast changing market and all that, net, if you still look at the last 6 year returns, still somewhere, depending on which strategy you are, it's easily somewhere close to 12 to 15%. And if you are, and if you want to outperform the index, then probably you will have to do a little bit of analysis on which kind of fund approaches do you want to plug in. And generally, if you look at passive, right, net, what is passive? Passive is effectively saying that the largest companies in terms of size will do better than the smaller size companies, because while we use the word passive, in all practical terms, it is that what does passive do? It just arranges all the companies as per size and gives a higher allocation to the larger company. So for passive to work well, you need a market where the largest companies deliver higher returns than the smaller sized company, which is why in US passive is a very, very large thing, because the largest companies have done extraordinarily well. But here we have also seen that in Indian markets, generally the experience has been that for most cycles, small and mid caps have delivered much better returns vis-a-vis large caps, at least predominantly for most part of the cycle. And hence you can say that passive, if you then apply that rule saying that larger is better, probably in Indian context, there are other better rules that can work better than larger is better. So what are those other rules? You can say higher the quality, I give higher weightage. So good quality companies in terms of high ROEs, low debt, those kind of companies can do it. So this is a particular group of fund managers would prefer this style. And then there'll be some fund managers who would say lower the valuations, the better. And then there'll be some fund managers who will say higher the momentum, the better. So there are different styles. So broadly, what we have generally seen is that if you combine momentum, small and mid cap, value and quality, and some bit of a growth style, and if you can put together 5 of these and diversify some part of the portfolio into global, then overall you get a very, very well diversified portfolio, And in each part of the cycle, while 2 or 3 styles might not do well, you again get rescued by the other 2. And overall, we've seen that this gives a very stable experience over a cycle. This is what we internally call the all-terrain kind of investing. Irrespective of the terrain, there is always 2-3 styles which do well, but you have no idea what is the terrain going to be in the next 2-3 years. And so you put together all these styles, and some 2 or 3 styles will always end up rescuing you. But over a 7-year cycle, we have seen most of these individual styles are able to outperform the larger is better kind of a passive style. So this is a good approach if you are thinking about trying to beat the passive over long periods of time. If you don't want to do that, then I think larger is the better is the starting formula for getting equity returns.
Right. So only equity. We are not talking about a multi-asset allocation strategy over here.
So this is purely from an equity standpoint. But again, historically, we have seen that if you do a 70% equity, 15% and 15% debt, you almost end up getting very close to equity returns. Today, it is slightly better than equity because gold has done extremely well. But again, historically, this kind of extreme returns have always been followed by cycles of weaker performance. But leaving that aside, when we looked at the 7-year rolling cuts of this model, which is multi-asset of 70% equity, 15% debt, and 15% gold, vis-a-vis a pure equity, more or less you end up with very similar returns, sometimes better, sometimes slightly lower. But the key point is that your downside significantly improves because the worst case, your Nifty 50 is somewhere close to 60% in 2008 cycle, whereas for the same portfolio, it almost comes down close to 40%. So it looks theoretically as a 20% fall, but if you think in terms of the upside required, it's almost like a 80% kind of a differential that it creates. So the key point is multi-asset helps lower the volatility, but without too much compromise on the returns. And I think over a long period of over a 10-15 year cycle, this can be a good strategy so that behaviorally also it's a little more easier to hang on. So I think multi-asset, diversifying across styles within the assets, and then curating the right set of funds, putting it together, and then having a very high savings as a percentage of portfolio rate, and then targeting 4-5 doubles. If you can get all of these together, I think in a 15-year cycle, you will be at a very, very good place. And then the explosive part of compounding in each and every double will take your portfolio to a very, very different level altogether.
Definitely. So diversification, disciplined approach, and in a nutshell, the real edge in investing is all about skills and more than being about avoiding errors. Well, with that, it's time up on the show. Thank you so much, Arun, for taking your time out and helping our viewers understand compounding in a new way from your new lens. Thank you so much for being on the show today.
Thanks, Kavita. Thank you for having me.
With that, it's a wrap on the Money Show as well. But then for anything about your portfolio, if you need our expert guidance, do send across your questions on the WhatsApp number and email ID. Thank you so much for watching. Goodbye.